This is the current federal tax developments for the week of December the 22nd, 2025. Current federal tax developments are brought to you by your state society of CPAs. Good weekend. We're going to have a little fun today looking at what's going on in taxes as we look at the updates for this week. And part of what's coming up this week is we've got a notice from the IRS regarding Section 25F, basically the upcoming scholarship funds or scholarship credits. And we're going to talk about some advance elections that states can make to indicate they will be participating in that program. We also have a case of a taxpayer with unreported income, and then the IRS runs into a little problem related to what it becomes the missing witness problem. In their case, we'll talk about that. We have a case challenging penalties under 6662 based on a result from the Supreme Court's Jarkesy case. I'll get that right. We'll talk about why the tax court decided that there was no right to a jury trial regarding those penalties. We'll talk about Section 280E, maybe one of the last times we'll talk about it, at least except for the one other issue coming up here. But that, if you don't remember, is the part of the law that says if you are a cannabis business, basically any business that basically is in the business of trafficking a Schedule I or Schedule II controlled substance, that you cannot claim a deduction for any expenses aside from cost of sales. The question became, okay, that means there are some huge tax liabilities here. When we have a taxpayer who was in that business and who was attempting to do an offer in compromise, indicating that there's no way they could possibly pay the taxes that were due. And the question becomes, when the IRS is looking for the reasonable collection potential from that taxpayer for an offer in compromise, is it basically not allowed for the service to say that they're going to ignore those expenses that would be not deductible anyway? So we'll talk about that. The tax court actually divided on this opinion. It's not a unanimous decision, but it was kind of interesting. And even some of the decisions, and some of the judges who supported the outcome of this case had different reasons why they would have supported it. And finally, we're going to talk about a taxpayer who had issues substantiating a purported bad debt, but also was kind of trying to pick and choose when he could use losses. If the losses had been legitimate, he was trying to say, well, I incurred those losses like 4 years ago, and I've never claimed a deduction yet. So I should be able to use that against all this income I've got in the current year. And we'll talk about why the tax court decided maybe that wasn't such a good way to look at it. So let's start out with Revenue Procedure 2026-6, issued on December the 12th of 2025. And this goes to those advanced elections made by states about whether they're going to participate in the federal scholarship credit program by essentially certifying that these charities that are going to be collecting the scholarship funds have complied with the requirements of federal law. So essentially this credit was part of the One Big Beautiful Bill Act that was passed back in July of 2025. This is going to be a non-refundable income tax credit beginning in 2027 that is designed to incentivize contributions to what are called scholarship granting organizations. And this particular revenue, rulings basically says, or this revenue procedure, we'll call those SGOs. When you'll see it throughout the procedure, you'll keep seeing that being referenced. Now, as I said, the credit doesn't actually kick in until 2027. But you got to start laying out some procedural groundwork because there's a lot of things involved here. Now, one of the things the statute does is it's going to be up to each state to decide if they are going to participate in this program. What they have to do, if they want to be able to allow essentially those living in their state in order to make this contribution to be used for private school scholarships in their state, the state has to essentially fund up and run a program to come up with a list of these charities and to assure they are following the required rules, right? So the state has to voluntarily elect to participate and be designated as a covered state. Now, under the statute, a state becomes a covered state by electing to participate and by submitting a list of compliant SGOs, scholarship granting organizations, to the Treasury generally by January 1st of the credit year. So by January 1st of 27, a participating state has to file an election and submit a list of compliant SGOs. And that'll be submitted by, January 1st of 2027. So the IRS is beginning to allow states to essentially get on the record of saying they're going to be supporting this issue. So the issue becomes that because the SGO list is required to finalize participation, but technically the SGOs have to know if the state is going to participate before anybody's going to start doing the work to comply with all these rules, because it doesn't matter. If you're not, if there's going to be no tax credits involved, there's no real benefit to the organization signing up for this program. We need the state to do it. So this is supposed to allow them to solve this. Now, remember, we still have a problem here because they have to both elect and submit that list. And obviously, they can't submit the list until the SGOs have given them the information, because as this particular revenue procedure made clear, the states can't just basically accept the SGO saying, hey, we followed all the rules. Just trust us, right? Self-certification will not work. So we know the states have to do something. We don't know, though, at this point, because IRS is asking for guidance on this, what exactly the state has to do. So it's kind of an open-ended issue. So if you're the state, you can volunteer to do this now, but we're not really sure what exactly you're going to have to do. How much are you going to have to devote? How many people are you going to have to hire in order to process these applications and do the due diligence that the federal government's going to demand you do? But in any event, under this Rev Proc 2026-6, we now have, though, the advanced election. So what happens here is we're going to break out into two different pieces, the election and submitting the list. As noted, you must do these, you're going to basically have to do both, or else the state won't qualify for that year. But we're going to get this advance notice, the theory being here. So it's kind of allowing the state to formally indicate its intent to participate relatively early on. That's going to allow organizations to essentially have the time they need to prepare for a rollout in 27. Because again, if your state's not participating, there's no point in going through the work to get ready to qualify under this program, because if the state's not going to certify you, you're not going to be qualified. That's the way the program is sent to work. Now, what they're saying here is they're being strict here. There's only one way to make this advanced election, which is Form 15714. They will begin accepting these advanced elections on January 1st, 2026. Now, in my mind, this kind of builds on an obvious question. What's to prevent a state from just saying, hey, we plan to do this, but not formally committing to it? It's like, well, probably SGOs are going to be concerned about the no formal commitment. I think that's part of what this is. Plus, there are definitely going to be certain states that just want to jump in and do this right away. There'll be other states where this is going to be way more controversial about whether the state should participate in the program. So expect that to happen. Expect that to be an interesting run. Now, one thing which they tell you, though, in this guidance, they said you cannot attach your list to this form. I don't care if you've got your list done at the time you apply. You need to essentially, the advanced election is for the election only. If you attach anything to the advanced election, the IRS will discard it. It's got to be a separate submission for your list of qualified organizations. Now, this is also a one-shot deal. Once a state has filed the advanced elections and there is a list of who's allowed to make that election on behalf of the state, the IRS is not going to process a second one. The only thing left to do after that is to file your SGO list. Obviously, if you make the election but don't file the list, then you didn't make an election. The catch is, though, it's kind of interesting if we got in that position, and you could, because again, there are going to be some states where there is going to be an election held, right, during the year. And we could see a change of control, which could, shift it either to wanting to be part of this or not wanting to be part of it. So that's where it's going to be kind of interesting following the year. Of course, in most of those states, the new governor and legislature won't take office until into 27. So in theory, whoever is there now would be able to do whatever they want to do and ignore, the incomings at that point. But it's still an interesting theory, especially if you had, for some reason, a change of control. This again is that one-shot deal means that once it's filed, you've made a partial commitment to go forward. Now, first thing is, that advanced election is not the final deal. You must perfect the election. It's just a preliminary step to perfecting your election. So what it's really doing is saying, hey, guys, we plan to do this. We plan to make this election. But until you submit the SGO list, you haven't made the election, right? So that actual list with all required certifications must be made by the deadline. This is where the problems come because we still don't know what the states have to do in order to basically to be able to certify. We do know we're going to certify it under penalty of perjury. We're going to, but the question is going to become how much information must the state get to assure that these SGOs are meeting their requirements for how much of what they take in is supposed to go out in scholarships. How do we make sure that's true? How do you make sure they're not violating rules where where they might be allowing people to assign the scholarship to some particular student? There are various rules under here, and the states are really the people charged with policing those rules. That will make it very easy. And whoever signs this for the state is signing under penalties of perjury, that all necessary steps have been taken. So it's one of those odd things. I could see that bothering some people, as to who's going to sign this thing, even if the state as a whole is all in favor of doing it. But maybe, they're all in favor, but they have a budget problem this year. So now the problem is the legislature never appropriated the funds to be able to actually hire people to do that work. That could get kind of interesting. Now, if the state that files an advance election fails to follow up with the list, the election is nullified. And that means no organization at state will qualify as an SGO for 2027, and there'll be no federal credits be available to donors in that jurisdiction. So it is kind of a big thing if they fail to perfect it. Now, some takeaways we've got right now, because again, remember, this whole thing for 26, the big issue is primarily for SGOs themselves. So if you're advising nonprofits, right, you need to monitor whether your state files Form 15714. And they could do it as early as, basically January 1st. They could file the form and go on record that they're coming in. Now, some states have already announced they plan to come in. So I'd presume most of those will file the form as early as possible in January. Other states may take a little longer, but you want to keep your eye on that. But you also have to manage expectations. Just because the state files the form doesn't mean we're guaranteed to be able to use the credit. You have to advise the client the credit is contingent upon the state adhering to the perfection process later in the year. That's both for the not-for-profit, but also for your clients who are thinking they want to donate to such a program. Again, it's a dollar-for-dollar credit up to $1,700 that you can get if you make a contribution to these SGOs. But they have to be SGOs certified by your state. Again, no certification, no credit. So it'll be interesting to watch and see how this all plays out. Next, we have a case of, and I'm going to murder this guy's name for no question, Cherno Mordikov, maybe that'll be, versus Commissioner, Tax Court Memorandum Decision 2025-129. This case came down on December the 15th. And we're going to talk about a case here about the IRS alleged that there's unreported income by this individual. And there's also going to be, when the IRS attempts to allege a fraud, they'll attempt to allege and try to get fraud penalties in place. We're going to run into a problem of what's referred to as the missing witness. And what exactly should the court draw from the fact that the taxpayer didn't call the preparer, up to testify in the case? And we'll discover that the court's not really going to give the answer the IRS likes in this case. And we'll point out the unique reason why that didn't happen. Because normally you will see the court saying, if the taxpayer is trying to defend what they did, and, they're claiming, let's say that, I defend that, and I did that because, I was told to do that by my tax preparer, or they gave me the advice, etc., and you don't call that professional, then quite often the courts are going to say, we're going to ignore that. You had the right to call them. It's your defense. Why, the fact that you didn't call them, I've just got to assume they wouldn't testify to what you just told me they had done. That'll be the presumption you have. But in this case, not going to quite work. So what we're going to look at here, this case deals with commingled funds, high-end lifestyle spending for this taxpayer. Now, this taxpayer managed an online electronics retailer, right? He was not a shareholder during the years in question, but he effectively controlled the corporation. He treated the corporate accounts as his own personal piggy bank. And by that, I mean he basically used corporate funds to buy himself a Lamborghini, a Ferrari, and a Rolls Royce. I mean, you need some variety in your life. So apparently he had this variety, 3 different, rather expensive luxury cars, right? Despite this particular, getting these luxury cars, spending money from the corporation, despite this income, and, there's going to be some fight over whether or not that was his income or the corporation's, he failed to file personal returns for 2012 through 2014. Now, in order to go into this case, the IRS used the bank deposits method to reconstruct what would be effectively millions of dollars in income for this taxpayer. As is usual in these cases, you have to remember the burden of proof is the first hurdle. And the Ninth Circuit Court of Appeals, which is where this would be appealed to, requires the IRS to link the taxpayer to the income source. Now, the tax court found that the IRS did that here by the bank deposits analysis. This taxpayer was living, he was consuming a lot of, had lots of things being bought, lots of consumption by this guy, and apparently no income for the fact he claims he didn't need to file a return. So, okay, we see all this income and we can't really explain how in the world he could have afforded this in this case. Now, what the taxpayer said was, well, no, it doesn't matter. All that money, all that stuff belongs to the corporation. Now, what the court did was applied a test for control. And they found that the taxpayer in this case had dominion and control and simply used the money for all of his own personal items. He's paying all of his personal expenses out of the corporation, paying tons of personal stuff. The corporation doesn't really use a Ferrari or Rolls Royce, right, or a Lamborghini, right? And they're saying that no, that looks much more like a personal item that's being used by you. Now, in this case, if the taxpayer said, well, if I did have income, I was going to offset it because I have cost of goods sold. Now, he said, because you see, I mainly pay my suppliers in cash. And that's what he testified. Now, of course, he had no direct records of this. And the court basically said, they're going to reject that. You have a responsibility to have records, records supporting your issue. And saying, as he did, I followed my stepfather's practice of paying cash for goods is not evidence that would be supportable. That's not records you've kept that's going to allow this deduction. And without any sort of substantiation, the court refused to apply the Cohen rule to estimate expenses, especially because he commingled personal expenses so much. Remember, fundamentally for the Cohen rule to work, for those who don't know what I'm referring to, it is a court case from the 1940s involving George M. Cohen, the entertainer, Yankee Doodle dandy, producer on Broadway, etc., where he didn't have decent records at all. But he still was allowed to claim some expenses. But to use the Cohen doctrine, which came to us from the Second Circuit Court of Appeals, you have to, have evidence, first that expenses were likely incurred. And okay, maybe we clear that here. There were costs of goods sold, almost certainly in this case. But the second point is there must be a reasonable basis upon which to estimate those expenses. And the court found the utter lack of any records here, and the fact that what they did know was he was spending all this money personally. There was no good way to estimate, what exactly would have been spent on inventories, what beginning inventories were, ending inventories were, etc. All of that was missing. So without any sort of substantiation, no basis to do an estimate, the court rejected applying a Cohen basically calculation to give him some sort of cost of sales. Now, okay, things didn't go great for the taxpayer there. Obviously, he owes a lot of tax. But the IRS was also trying to say that they should be able to impose the civil fraud penalty, that this was fraudulent conduct. Right? This one is interesting how the IRS is going to lose this one. Now, the taxpayer used a preparer. This was a former IRS agent named Mr. Lee. Mr. Lee was investigated by the Criminal Investigation Division of the IRS. Now, the IRS argued that because the taxpayer in this case didn't call Mr. Lee to testify, that the court should infer his testimony would have been unfavorable. Now, here's the problem. The court said, first thing is, the burden really is on the IRS's side when you're arguing civil fraud. And the court noted that Mr. Lee could have been called by the IRS. The IRS could have basically called him up. They elected not to do him. Even though they listed him as a witness, they never called him to testify. And so the court said, failed to call a preparer left a big hole in the IRS's proof of fraudulent intent. And they weren't going to hold that against the taxpayer because that wasn't who was trying to prove something here. This is not a case of a defense, right? Because remember, the burden on the IRS, they first have to establish, the base prima facie case. And then the taxpayer could produce, rebuttal. But we didn't even get to the point where the taxpayer needed to produce rebuttal. They couldn't prove by clear and convincing evidence, which is the level they had to, that essentially there's a taxpayer, what they had told the preparer, and therefore, was the taxpayer involved in, what was their fraud involved in this case? The IRS needed the preparer's testimony. They didn't get it, didn't try to get it. Yes, they may have believed he was going to plead the fifth, but if they had, then the court might have said, well, okay, it's open there. We can infer, not from the fifth, not indirectly. We could infer that, there's probably something there. Clearly, this guy wasn't called. He's not being cooperative. But in this case, nobody called him. We don't know if he's cooperative or not. Court said, IRS, you had the burden. Tough luck. You've lost it there. And now, finally, there was an interesting problem here regarding a stipulation problem, right? Prior to the case, the parties had stipulated that the taxpayers in this case were entitled to a married filing joint status for 2013. Now, here's the catch. Generally, if you cannot file a joint return if you never filed a return, and so the IRS did, they went ahead and prepared a return for them. And the IRS, though, stipulated that this could be a joint return. That's effectively wrong as a matter of law. But the problem is when the taxpayer tried to argue married filing separate rates later, the court said, no, you stipulated it, right? That's kind of where we're at. You had stipulated they could do joint, we can. That is going to lower the tax that they would owe. However, now the flip side, what didn't go so well for the taxpayer, remember, he didn't file his return for 2018. Or I should say, I should say, this would be a later one. I'm mixing up my cases now. In this case, what he tried to do, was try to rely on his agent as an excuse for why he failed to file a return. Blame the preparer. The problem is you cannot rely on the actions of an agent to get you out of a failure to file penalty. This is the Supreme Court's Boyle case. That standard is still in place. You cannot blame it on the preparer. Well, put this way, you can, and you may get a civil judgment against the preparer in state court. But as far as federal court goes, you're still liable for failure to file penalties. Those are still in play. Next up, we're going to take a look at the tax implications of the Jarkesy case, right? SEC versus Jarkesy. This case is the case of Riddle Aggregates LLC versus Commissioner. It is a reported tax court decision, 165 TC number 12, and this decision came down on December 15th. Now, this is a TEFRA partnership case, but the issue here, not really going to do much in the TEFRA side for this, but this is a case that will test the waters in the tax realm after the Supreme Court's case and ruling in the case of the Securities and Exchange Commission versus Jarkesy in 2024, which held that basically the penalties the SEC were going after from Jarkesy, they essentially represented a quasi-criminal penalty for which the Seventh Amendment gave the accused party a right to a trial by jury. Now, the taxpayer said, see, based on that, these penalties the IRS is trying to assert against us, right, from the partnership for these penalties under 6662, they should be thrown out because, we can't get a jury trial in the tax court. And since we can't get a jury trial in the tax court, that means that, in essence, no penalties could ever be asserted in the tax court, right? So they say the court should zero out the penalties, and just get them to zero. We shouldn't have any penalties as part of this. Now, here's where now the tax court, this is the first time the tax court had to consider this, right? So here's the catch. The court rejected the argument. The court distinguished this case from the SEC's suit against Jarkesy. They noted in this case, the taxpayer is suing the government, right? And that makes a big difference because we end up with this concept called sovereign immunity, right? You can only sue the government if the government agrees to allow you to sue it. Now, in Jarkesy, the government sued the private party. That's directly how the Seventh Amendment is going to work, right? The government's coming after you, right? Taking you to court for a penalty. You have a right to have that heard by a jury trial, at least if it meets certain criteria. In this case, though, the taxpayer is suing the government to stop an assessment, right? The government has the administrative right to assess tax against you. You have the option of going to tax court and you can stop that assessment. But because you're suing the government to stop the government from doing something that it otherwise would be able to do, this is not the same thing as what resulted in the jury trial option for Jarkesy in the SEC's move against Jarkesy. And this relies on the recent Silver Moss decision, right? Silver Moss Properties, which came out August of 2025. The court held that the Seventh Amendment does not apply to suits against the sovereign and said, look, the taxpayer fundamentally misapprehends the nature of their own suit. Right? This is not like the Jarkesy suit because Jarkesy was not suing the government, right? This was essentially the government coming after Jarkesy. Now, in this case, this is the taxpayer suing the government to prevent the government from going ahead and assessing penalties. And, I'm sure a lot of taxpayers have trouble understanding the difference there. But yeah, it's a very real difference. Because, of course, what they could have done was paid the tax, paid the penalties, and then sue for a refund. Now, that gets a little more interesting. Again, you'd still be suing the government. Different issue. But in this case, we don't have the issue, right? Even if, though, the court held, even if there was no sovereign immunity here, the court then said there's a second reason why. They said the public right exception to the jury trial. And they note that revenue collection is a public right, right? And they take that back to the case of Helvering versus Mitchell from 1938. Right? The actually related penalties are really civil incidents of the assessment of tax. They trace back to 1926 and 1954 codes without any substantive change in nature. And basically, they've already been addressed that these things are considered a public right or an administrative function used to enforce the tax code. Now, the petitioner tried to cite, in this case, Schwartzbaum, which was a FBAR case, right? Remember the foreign bank account reporting report, where penalties were deemed punitive fines. The tax court distinguished that one right away. They said FBAR penalties under Title 31 are fundamentally different from tax penalties under Title 26. The 6662 penalties, which are nowhere near as onerous as the FBAR penalties for intentionally not filing your FBAR form, These are remedial. They exist to protect the revenue and deter non-compliance, but they are not punitive in nature because they're just not high enough. Therefore, they fall within the public rights exception, and the court denied the motion to throw out all the penalties. Of course, if the taxpayer wants, they can now appeal this case. We'll see if they plan to do so, if they have the funds to do so. It's kind of one of the issues. Next up, this may be one of the best cases of bad timing ever, but this is a case of the Mission Organic Center, Inc. versus Commissioner. There actually are two different opinions here, two different cases. There's a set of years that are decided as part of a reported opinion, 165 TC number 13, and then there is a tax court memo decision, 2025-130, that covers a single year. All of these came out on December 16th. So that's when we're going to go ahead and look at this. Now, this involves the cannabis industry, right? And so this is kind of interesting because, as you may be aware, we'll talk more about it next week because I hope we'll have a little bit more information about what's going to be happening going forward. Just this week, the president signed an executive order that is going to effectively, remember that whole thing we talked about last December about there being, an attempt to actually last half of last year, that there was an attempt to reschedule cannabis from Schedule 1 under the, Controlled Substances Act to Schedule 3, which would have taken it out of the coverage of 280 Cap E. Well, after the change in administrations, nothing happened with that proposed change in law. Basically their proposed change of the rule for a new final rule. Well, looks like we're now going to pick it up again. In August, the president stated that within a few weeks, he was supposed to be issuing a notice. Well, turns out it took a little bit longer than a few weeks in this case, but we now have it. So makes this case really interesting because, as I said, I just feel bad for the taxpayer because this may be an incredible case of just bad timing. We'll see what happens here. In any event, the taxpayer Mission Organic Center was a cannabis dispensary, and it owed millions in income taxes. Because of the way 280 Cap E works, no deductions except cost of sales if you're in that industry. You're going to always have this huge amount of tax involved because you're going to lose all your regular deductions. And the only option to have enough money to pay the tax would be to raise the price on the cannabis you're selling to such a high level that nobody would buy it from you. So fundamentally, there's a problem here with paying the taxes. And assuming you're not capitalized well enough to survive, hoping 280 Cap E goes away, you got a major problem. You're going to keep getting further and further in the hole to the government, which, of course, Mission Organic did. Right? They just got bigger and bigger in the hole to government. So now they're trying to go down, a collection alternative, and they're trying to use an offer in compromise. Right? They're saying, look, realistically, there is no way we can pay this, right? We're not going to have the free cash flow to be able to pay anything significant. They offered $65,000 to settle the debt. Okay, that's on millions of liabilities, $65,000, but they're going to settle it and offer in compromise. And the dispute was a calculation of the reasonable collection potential Mission Organic Center had, because the IRS will not accept a offer in compromise unless it is at least equal to the IRS's reasonable collection potential. That, in theory, is how much could they expect to collect based upon the cash flows, income to the company, assets that are available to them, before the statute of limitations on collection runs out. And they had computed, essentially, that even though 280 Cap E disallowed expenses for tax purposes, right, the taxpayer said, they're real cash, we got to pay them. And the problem is the IRS was going to exclude those expenses, or was going to basically ignore those expenses when computing how much they could pay in collection. Well, in this reviewed opinion, which covers 2016 through 2020, the IRS's policy found in the Internal Revenue Manual of not counting any of these expenses in determining your reasonable collection potential, that was upheld by a majority of the court. So under the IRS's calculation, right, by taking gross income, subtracting only cost of goods sold, the IRS ignored all operating expenses because of Section 280 Cap E, and that resulted in their calculation saying that this company could pay $57 million. A little bit of a difference there, right? So $57 million, obviously they're not going to accept $65,000. Now, we understand that in the real world, there's no way this company could pay $57 million, at least until 280E changes. 280E no longer goes. But the majority of the court held this was a valid exercise of administrative discretion. And what they said is the IRS is allowed to adopt collection policies that mirror the public policy of Section 280 Cap E. And so they're saying because of that, their policy found in the Internal Revenue Manual is fine, and that policy results in the $57 million calculation. So that means effectively phantom income can be used to reject an OIC because, they're just not going to have the cash flow. But because of public policy reasons for 280 Cap E, the IRS has taken the position that they can't count those expenses looking at reasonable collection potential. That's just not what's available. Now, the judges that dissented, and there are a few dissents in this opinion, so they're called 3 flat-out dissents, they all said, nope, you're ignoring the reg. They're saying the underlying reg effectively tells us that we're looking at essentially cash flow. And clearly, these expenses are cash flow. And they also point out that if you're going to offer up an installment agreement, well, then they will take this into account. So apparently, and of course, the installment agreement would never be enough to actually get it paid out. So they're saying, look, in the whole thing there. And also they said this whole justification of public policy was not the initial justification for rejecting this, right? They said they kind of put that in there for the service. However, for 2021, the memorandum decision year, the taxpayer did get a reprieve. And maybe everything will clear up with 280 Cap E or with the rescheduling, that maybe this could help them handle this. Although, because remember, if those expenses are not covered by 280 Cap E, then they would be legitimate expenses of the business going forward. And then you would likely be able to reduce their collection potential, down, maybe not to 65,000 anymore, but probably much, much closer than it is to the 57 million. So what happened here in this case? Why did they get a chance to go back for 2021? Well, these are mistakes made by the appeals officer, right? In 2021, the appeals officer made 2 blatant mistakes in rejecting their appeal. They did a collection due process appeal on the offer in compromise, and the appellate conferee, denied, any relief here. And what the problem was, the report of the appeals officer claimed the taxpayer was challenging the underlying liability. The court said, I'm looking at what they filed. They weren't. They were challenging collectability. The appeals officers for the other years picked that up, right? But this one did, missed it. And also, she claimed no financial documents were submitted. And the court said, we've got them right here in the file. They were clearly submitted. So they said, because while the policy is valid, the process must be fair, and the appeals officer clearly just ignored the record. Now, I admit, she probably decided, look, given where this is going, they've already had 3 years rejected. This is going to be a rejection. Why should I waste tons of time on this? The problem is the appeals officer has to spend the time. And her rejection had to be for valid reasons, which means she did have to go through and explain reasonable collection potential, how she computed it. She could then rely upon the government policy. They'd been fine with that, but this one's easy. As the judge that wrote this memo opinion pointed out, they said this was a way easier one to write, right? Because there's all this disagreement on the other one, but this one's easy. The appeals officer simply blew it. Now, I guess the good news is, since she blew it, it's going to be remanded. By the time it gets back in front of appeals, you may very well find that there is no 280th problem anymore. And that's kind of helpful because one of the reasons the IRS also pointed out, and the court pointed out, why they shouldn't allow the offer in compromise is because the company's going to be in the same mess every future year. If they can't deduct those expenses, they're going to have tax liabilities way in excess of what they can pay. So the offer in compromise doesn't really offer the clean slate in that scenario. But now, if we're going to actually be able to claim those deductions, and it also means, and so in that case, being able to claim them, well, then we're actually setting them up to get the clean slate and then restart. Essentially start where they will be able to pay the taxes involved. So anyway, it's an interesting thing and an interesting structure there. So a couple of takeaways for those in cannabis. If 280E for some reason doesn't happen, if this whole rescheduling stalls again, then the IRS now has official tax court judicial backing to use 280 Cap B to inflate the reasonable collection potentials. That means offers in compromise are very difficult for cannabis businesses unless we get the rescheduling, right? And the other issue to note here, and this one applies in general, don't give up on procedural errors if you're challenging the service, right? Even if the policy is great, the fact that the settlement officer misstates facts or ignored documents, you can still get a remand under what's referred to as the Chenery Doctrine, right? Prior case from years ago. They have to follow, they have to give, basically follow the proper, fair procedures. And even if we know where that's going to go, if there's no change in 280 Cap E, the result's going to be the same as the other 3 years. You still has to follow the actual form and follow the procedures. You can't just kind of like dismiss the whole thing and dismiss it for reasons that just have no basis in fact. Next up is a case of Fussell versus Commissioner, Tax Court Miranda Decision 2025-131. This one came down on December 18th. This one deals with bad debts and NOLs. Okay. Now, here's the basic background we have, right? So this is going to deal with this. This taxpayer advanced $420,000 to a software company, right? Velodome? Don't know how we pronounce it, but we'll go with that, right? The checks when he wrote them says note record, right? But there were no promissory notes or loan agreements ever were prepared, ever existed with regard to this. Around 2014, this company that he'd loaned the money to dissolved. Now, what happened in this case was that the taxpayer he tried to claim this bad debt deduction to offset income in 2018. He claimed it was a carryover, an old carryover. And he claimed that it was a carryover because he had never deducted the funds before. Now, this is also a case where in 2018, the year in question, the taxpayer had failed to file a return. The IRS issued a substitute for return. So now the taxpayer is, in court challenging that. And that's obviously the reason why he's now flailing around and found, I loaned this company all that money. I have this loss. I've never claimed it before. That can offset my income. Now, the problem is, and he tried to say it was net operating losses coming forward, because obviously the business was long gone, who he had loaned it to. So this was not the year, if it was a bad debt, that it went bad. And that's one of our problems, though. The taxpayer said, I never claimed the deduction in 2014, so I should be able to use it in 2018. That's not how NOL rules work. And it's not the way tax rules work in general. You cannot just say, hey, I got these deductions I didn't claim like 20 years ago, and now you're coming after me for tax due. So, I should be able to offset the two. You can't really sit them back there and like bank them, and hold them until you have a year you want to use them against. Rather, under Section 172B2, in the year in question, let's say incurred in 2014, those losses would have gone back 2 years and then would have been carried forward. Now, this taxpayer essentially had over $300,000 of income in those prior years, right? Even if the deductions were valid, the mechanics of 172 would absorb the loss back then. So, you just can't bank the deductions. Now, remember, the court already decided with no notes, no things like that, this looked like equity, right? It was not a bad debt. But even if it was a bad debt that had led to an NOL, a business bad debt that could have created an NOL, it'd be irrelevant because he had more than $300,000 worth of income. The only thing you could do if you did establish that you had this loss back in 2014, you'd have to be able to establish how much of that loss would have been absorbed by the 2-year carrybacks and how much would have been absorbed by the carryover years. And because he had significant income from all the prior years, that would have absorbed this loss when he attempted to claim it. And therefore, there'd be no loss that was alive in 2018, which is the year he's trying to claim it. Now, the other thing that happened here was the taxpayer also said, well, I shouldn't be hit with failure to file penalties. And his reasoning was that he hadn't filed a 2018 return because he was being audited for prior years at the time. And so he's holding off filing his 2018 return until the audits were done. Bottom line, that is not a valid excuse, right? Pending disputes do not justify failure to file the current year's return. So failure to file, failure to pay, and estimated tax payment penalties were all sustained against the taxpayer in this case. Well, we're coming down to just one more of these during 2025, these sessions. So hopefully you're going to have a good time working there. I will see you back on the other side of the Christmas break. Let's say, we're in the week for Christmas, so you're going to find out that, well, traffic's light this week. Generally, we'll phrase it that way, because I have a feeling with the 24th coming up on Wednesday, 25th on Thursday, and Friday, just being a Friday, I have a feeling that a lot of people will either not be at work at all this week, or will be at most on Monday and Tuesday and then disappear. So it's going to be that week. But in any event, I still do, keep an eye out for questions to come. You can email me, edzollars at thomaszollarsLynch.com, which is on the screen right now if you want, if you're watching the video portion of this. If you have a quick question and I can help answer it, I'll try. Otherwise, I also do pay attention to the Connect listservs run by the Arizona Society of CPAs, New Jersey Society of CPAs, Minnesota Society of CPAs, Idaho Society of CPAs, and Washington and Illinois. So if you remember one of those, you post a question, I may see it and respond to it. Otherwise, though, we have one more time before we get into 26, and actually just a few more, like I said, less than 2 weeks for anybody to do anything for planning for this year, aside from, making IRA contributions after the end of the year. As we always tell clients, there are very few things you can do after the end of the year. Tax planning takes place now, not in 3 weeks. 3 weeks from now, we're very limited what we can do tax planning. So in any event, hopefully you survive through the tax planning season. Then we'll have that very short calm before the storm in January, and then all the fun of tax season picks up. But in any event, we will see you all back here next week on current federal tax developments.